It's time for the Bill Ferguson Show.
I almost can't believe the value of this show. You should be paying twice the price that you're already paying, which is $0. I'm joking aside. This would be where I would normally ask you to go sign up for Patreon or some other platform and donate some money to me. I've long since stopped that, and you'll notice, I hope, let me know if this is not the case. There's no ads in this show. I'm making no money directly by doing this show. I threw in the word directly because occasionally a few people that listen to the show contact me, we talk, and then a smaller percentage of those people eventually hire me. So it's not purely altruistic why I do this, but that is a big important factor. I do see myself as a consumer advocate. I am trying to teach you how to invest. And the stuff that's in this show, I don't know where else you would get it. And of course, on top of that, the extra bonus of talking about politics and how cool it is to be an atheist and understand the world, how it really works. But this episode is more about investing. We are going to talk about how to review the mutual funds in your portfolio. I'm not going to give away all the secrets. You're going to go listen to that segment a little bit later in the show. I'm also going to talk about a thing called return of premium term life insurance. You put all the money in to get term life insurance and they give it all back to you free. You get 100% of your money back. And I'm going to walk you through the mathematics of why that's nowhere near as good as how it sounds. And then I'm going to have a small clarification on prior podcasts where I'm discussing about withdrawal rates and just a little cleanup. Maybe I wasn't precise enough or didn't articulate well enough some ideas in that previous segment. So, I can clarify. When I make mistakes, I come on here and correct them. I haven't gotten the emails lately, so I thank you for not sending those emails. But every once in a while in the past, I would get emails where people say, stop correcting yourself. You ruin your credibility. My general response for that is, fuck off. I make mistakes. We all make mistakes. It's the people who can't admit their mistakes that really scare the shit out of me. Investing is fucking complicated and the rules change all the time. I make plenty of mistakes. And when my super smart listeners find those mistakes and send me really nice emails, please, thank you, I come on my show and I correct them. I actually don't have anything specific in mind today, but it just popped in my head. I do appreciate a gentle nudge that I've made a mistake so I can correct it, because it's really important for all the listeners to get the best possible information. That's my goal. Sometimes I miss the mark and I want to, like in this case, clarify something or fix something. So if you catch a mistake, great, let me know. Please be nice. It makes my life a little better. I did want to touch a little bit, just a teeny little bit, on Silicon Valley Bank. And there's a lot of things going on, and it's complicated, and nothing's ever as easy as it seems. But there is one part of why they had trouble that was so obvious and painfully easy to avoid that I don't know. I don't know that it's criminal, that they should have jail time, but how do these people get their jobs? How do they keep those jobs? And are they going to go somewhere else when this bank gets all broken up and sold to other banks? One of the things that caused them big heartburn is they had something like, I think, $20 billion in long-term bonds. If you have listened to this show even off and on for the last 3+ years, you have heard me talk about avoiding intermediate length and especially long-term bonds, because the teeny little bit extra of dividend that they're going to pay is not worth the potential risk if or when interest rates go up. As little as a year and a half ago, the Federal Reserve's overnight lending rate between banks and the Federal Reserve was essentially zero, which I consider to be probably the lowest possible number that it's going to ever be. As a point of fact, some other countries actually had overnight lending rates between their federal bank, the Federal Reserve for their country, and their banks. They had lending rates that were negative. I'm not going to go into how that works, but it's kind of mind-altering that that's a possibility. My position was that because of the American population's inability to understand negative numbers, that would never fucking happen here, and it didn't. It went to zero, and it stayed there. I'm on record for years and years and years saying it stayed there for too long, and it should have been a nice, slow, gradual increase over time. Well, they left it low, and everything went fine for years. Okay, cool. Then COVID, supply disruptions, international shipping problems, and the shit hits the fan, and inflation shows up. And here's another thing where I thought it was going to be more transient, more temporary than it was. All right, see, I was wrong. I was just talking about that. I thought it was going to come and go within a year. It stayed around a little longer, and it's now decreasing, in part because the Fed is increasing interest rates. There are other things that the Fed can do, not necessarily the topic of this rant, but I'm nobody. I'm just a dumbass with business and a podcast, and I could see that interest rates were likely at some point, I didn't know when, but they're gonna go up. But yet people at Silicon Valley Bank have $20 billion, I think it is, $20 billion in long-term U.S. Treasuries. What the fuck is wrong with you? That's just absolutely staggering to be in that position. What drove you to do that? Really bad idea. That mind-numbing to me. The other thing that affected them, they took advantage of an exception. Big banks have to do this. Medium-sized and smaller banks don't have to do this. And I think this is fucking wrong. And it was an exception that was passed by Congress and signed by Trump. I don't know that I can blame him for this because he probably doesn't understand what he signs. But what it did was it exempted medium and small banks from a thing called mark-to-market. So if you own $20 billion in long-term bonds and interest rates go up, and you realize that your $20 billion of long-term bonds are now worth $19 billion or $18 or $17 or $16 billion, you have to change the number in your calculations to show how much money you have on reserve. And you would do that probably daily. You have to adjust that number. And when you adjust that number down as interest rates are going up and your assets are falling in value, you now have to save some more money. How do you save more money? You start giving out fewer loans. You start calling in loans. You start borrowing money from the Fed overnight at higher interest rates. The purpose of the higher interest rates is to cause things just like this to happen, where slowly and gradually, one would hope, although that's not the case here, that a bank would lend out a little bit less money, not take on as many risky loans, another problem for Silicon Valley Bank, but do fewer loans, do only safer loans, call in loans, have people expedite their payments for the loans, borrow more money from another bank or from the Fed overnight, and it starts to constrict the supply of money so that everyone has a little bit less money. And when people will say something like, if they keep tightening interest rates, the economy is going to get weaker. Yeah, that's the fucking point. Now, you can argue whether that's good or bad, not this segment, but you can't have 10% inflation or higher year after year after year. It's not a stabilizing factor. That must, in my opinion, that must be nipped in the bud. And the Fed is doing what they have to with interest rate increases and other things. Again, not the subject of this segment. But Silicon Valley Bank, why, how? They had all these long-term bonds, and because they were not required to mark to the market, their $20 billion of long-term U.S. Treasuries, when they fell from 20 billion to 18 billion or 16 billion in value, they still listed them on their books as being worth $20 billion. They didn't have $20 billion. And some people found this out and started issuing warnings and cautions. Some people started pulling money out. Some people started selling the shares of the stock of the bank. And then when enough people find out, you get a run on the bank. And when the run happens, the bank says, okay, now we have to sell these bonds. If we were allowed to keep them for another 15, 16 years, we would have gotten the 20 billion back. Yeah, whatever. Rainbows and unicorns. You can't wait 15 years. You got to sell them now because people are taking money out. And they sell them at a big discount. The money now is recognized as a loss, and suddenly they don't have enough money on reserve. Well, they didn't have enough money in reserve before. They just didn't have to recognize it. They could just put their hands over their eyes and go, the money's all here. So that's one of the driving factors of how they got fucked, because they were investing poorly and they weren't required to adjust the value of what they had on their books as reserves down, even though the investments that they had gone down. That shit's got to get fixed. And that's a Congress thing, and they got to fix it. The other thing that should happen is that, I hate to say it, but every single person who has money in that bank should get 100% of their money. We can argue about how that happens and whatever. But the management, they should all lose their jobs. The executives, they should all lose their jobs. The people that were buying long-term bonds and not marking them down, even though they didn't have to, they still fucking should have. They should all lose their jobs. People that own stock in this bank, they get whatever residual amount they can, that whatever's left over after, and only after, everyone that has deposits gets all of their fucking money back. This bank cannot be bought out. We cannot allow people to get bonuses and continue to get multi-million-dollar salaries for fucking shit up. They just have to lose their jobs and do something else. And people that own shares in this bank need to feel the pain. They need to feel the loss, because then people that own large amounts of other banks will go to the board meetings and say, hey, are you doing the same stupid shit that Silicon Valley Bank was doing? We need to not do that. Of course, I would prefer that banks be forced back to being banks. And we go back to the old-timey rules that came up after the Great Depression, where insurance companies are insurance companies. Companies that want to go out and invest huge money for huge returns and huge risks in startup companies are separate, and banks just bank. They take in some money, they hold a generous portion on reserve, and then they make loans for you to buy a car or a house or some land or start a small business, maybe even a large business. But that's what they should do. We should know, we should expect. We need to guarantee as a society that money that you put in the bank is going to be there and you can get it out whenever you want. Anyway, enough ranty. We'll take a quick break and go into all the action-packed stuff. And like I said, there's no way for you to contribute money to me, but if you find what I say valuable and interesting and you want to talk to me, send me an email, phil@polarisfinancialplanning.com. Do not send your social security number. Do not send any statements, at least not to start. After we talk and you know for a fact that you use the correct email address, then maybe I can review a statement or something. Again, if it's just a one-off or two-off, it's free. There's no charge. If you decide you want to hire me, that'd be awesome. Despite what my website says, because I'm horrible with my website. The current minimum for new clients is a thing they call assets under management of $2 million or greater. So your house doesn't count, your car collection doesn't count, land doesn't count, other rental properties don't count. It's only the assets that I can manage. So IRAs, Roth IRAs, taxable accounts, does not include your 403B or 401k or TSP. It has to be stuff that I could actually go in and adjust. Anyway, so 2 million of assets under management for new clients. If that's you, please do send me an email. But if it's not you, and you just have some questions, you can still send me an email. So all that stuff is available. Again, you can't contribute money through Patreon or something, but what you can do is go and give a 5-star review at Apple iTunes, Apple Podcasts, whatever the name is of today, or I think it is Stitcher is the other site. Of course, you can refer friends. That's always great to have new listeners to the show. The other thing that you can do, I would love this. I think this would be cute. You go to some other podcast, people who aren't making money like Phil, people who are doing great shows. And for me, particularly if they are secular or atheistic shows, soft spot in my heart, and go donate some money and say, hey, I donated this to you because Phil Ferguson told me to. Because there's a lot of people out there doing great content who are making next to nothing to help educate people about the evils of religion and how it hurts our country, our society, and our citizens. So go support them. I'm not shitting around here. Go send them some money. And if you want to say Phil Ferguson show sent me, that'd be kind of cool. But anyway, do something to help us all out. All right, rant over. We're going to take a break and go into all the really cool stuff for this show. The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. This is a little update to a previous segment on a previous episode about the amount you can take out per year in retirement. Had a great email from a listener. We're going to go with MB are the initials. They will know who they are. Thank you. I did do an email response, but I do want to thank you for this very thoughtful and including email. I do appreciate it. MB wanted me to point out, and this is very important, so thank you again, that when I talk about taking out 5% of the portfolio as an example, if that's the correct rate for you, given your age and your assumed level of risk and understanding that markets can go up and down. And again, if you have a $1 million portfolio and you're entering retirement, and for me, for my guidelines, 62 to 67 years of age, you can take out 5% per year. In the first year, that would be $50,000. Hang with me here. I'll get it done. $50,000. I then did not clearly articulate that the amount that you take out next year would stay as $50,000. So once you set the percentage that you want to take out, in this theoretical case, $1 million, 5%, $50,000, when you get to the second year, the default assumption, I want to make this perfectly clear because I did not, is that you will not adjust and take out a new different 5%, but you will take out $50,000 again. Of course, many of the other caveats still apply. If you could reduce the amount you're taking out, that would be great flexibility. If you increase the amount that you can take out every year, assuming your portfolio goes up, you're then adding additional risk that I was not accounting for in that original 5% or $50,000. The reason, once it's set, the $50,000 or 5% of $1 million for the initial position, is that data suggests that most people in retirement, whatever dollar amount they take out per year, they tend to keep taking out that dollar amount, and they're successfully able to go through the rest of the years until the last couple of years when medical expenses can jump. The other thing that I do assume in my model is that Social Security does not go up. So that's kind of a little perk, a little bonus, because when Social Security goes up, that is additional income that you're not taking from your portfolio. You're getting that from Social Security. So I think that offset of not changing the dollar amount from $50,000 to some higher dollar amount, yet still at 5% when your portfolio grows, is a reasonable set of assumptions to make. You can disagree with me. You can be more conservative. There's just different ways to look, but it's important that you do understand that little nuance that I may not have been clear about. Let's say I was not clear enough about in the previous segment. Now, one more thing to muddy those waters of those assumptions. If you have a period of time for 2, 3, 4 years where the market does really well, and you are continually rebalancing once a year, once every other year, depending on what happens, at some point you might change the size of your cushion in terms of absolute dollars, even though it might still be a smaller and smaller percentage of your portfolio. As an example, over 5 years, the stock part of your portfolio goes up 60%. 5 really good years. Okay, it could have happened. It's happened before. And the bond portfolio maybe goes up 3 or 4% per year. Without sitting down and doing the math, I think you can easily see that if part of your portfolio is stocks and it goes up 60%, and part of your portfolio is bonds and it goes up 4%, the part of your portfolio that's stocks becomes a larger percentage of your overall portfolio. If you are rebalancing and skimming some of the stocks off and refilling bonds, again, after a couple of successful years, after you've added to the absolute dollar amount in your bond portfolio, you could consider resetting the 5% that you're taking out. So if your portfolio was 1 million, and even with some deductions, because most of that's covered by stock and bond dividends, but the stocks appreciated quite smartly, and you've taken a little bit of stock out to spend it, but let's say now your portfolio is no longer 1 million, but 1.4 million. If you are so inclined, you could reset the 5% based on the 1.4 million and not just the million. So the new 5% would not be 50,000, but 70,000. So that can be done. I just don't do it automatically, and I vigorously recommend you doing it in a time of market stress where the market, the stock market, the US stock market, the international market, your equity investments might be down 10, 20, 30, 40 or more percent in a year or 2 or 3 period. That is not a time to increase the dollar amount that you're taking out. If anything, as I dropped in just a few seconds ago, if you can reduce the dollars out for a year or 2, even if it's going from 50 to 45 or 47 or 42, that can be very helpful in assuring the long-term stability of your portfolio. The 50,000 is very, very likely to be okay and not affect your portfolio in a large negative way because you have cash locally, you have some cash in your portfolio, and then you have bonds in your portfolio. You have all the dividends from the bonds and from the stocks, and so you can wait out that drop while still taking money out of your portfolio, mostly from dividends and the bonds. That's the point of the cushion. After a market drop, or if we have several years of really strong growth in the stock market, and as I said, if your portfolio grows to be materially larger, and you rebalance and you keep a certain amount of funds in the cushion, and of course, if you increase the amount you take out, you probably would increase the amount of cash locally, the amount of cash in the portfolio, and probably, while it might be a smaller percentage still, a larger dollar amount of bonds in the portfolio. And this could allow you to increase incrementally over time, every once in a while, every few years, the amount you take out while still having the portfolio balanced in a correct way for you and your cash flow needs. Anyway, I didn't want this to be that long. I just have these thoughts pop into my head. But the basic gist of the email is correct. If you start taking out 5% of $1 million, $50,000, that's your reference point. You want to stick to the $50,000 until you have the financial means to change it to a higher amount after years of average or above average market performance where your portfolio has grown beyond the initial amount. But starting with 50,000, stay there. And that's the base assumption of the models that I ran in the previous segment. So I hope that helped. Maybe it did, maybe it didn't. Let me know if I've made it more confusing or confusing for you. Email me at any time, Phil at polarisfinancialplanning.com. I'm going to wrap this segment on and go into something else fun.
Pace e lunga vita. Lunga vita e prosperità.
A lot of people come up here and they thank Jesus for this award. I want you to know that no one had less to do with this award than Jesus. He didn't help me a bit. If it was up to him, Caesar Milan would be up here with that damn dog. So all I can say is, suck it, Jesus. This award is my God now.
You're listening to The Bill Ferguson Show.
This little segment is on a cool thing called return of premium term. It's a type of life insurance, term life insurance. You may have heard buy term and invest the rest. I strongly support that. Was recently talking to one of my clients, and we were talking about insurance and life insurance and term insurance. And one of the things I haven't covered in a while, because in my head, I've gone over it so many times, I don't think that it needs to be recovered, but not everybody has listened to every single one of the 400 plus episodes of the show. So things have to come back and be readdressed because it hasn't been discussed for a very long time. Now, one thing is that I don't sell life insurance. I actually got registered to sell life insurance many years ago and then found out that it wasn't really helpful to me and or my clients, in my opinion. So, I mean, you can have a different opinion. If you want to find someone that will strongly suggest that you get life insurance, talk to a person that gets paid commissions to sell life insurance. They will give you all the reasons, maybe some of them good, to have life insurance. And I definitely think that if you are in your 20s or 30s, or if you have a couple little kids, especially if you have only one person bringing home the income, a little bit of term life insurance, and by a little bit, maybe $1 million or $2 million, whatever, think about it, contemplate what you think is necessary, and that might be a good thing to have. The reason it's a good trade-off is because if you are the one income earner and you die, your spouse, if you have one, your kids, if you have them, if you don't have a spouse or kids, I might have to question why you have insurance, but that's another topic. But if you think that you need insurance, fine, get some insurance. And again, get term. The fancier the insurance gets, the more likely, in my experience, I don't even say my opinion, in my experience, the fancier it gets, the more likely it's a bad thing for you. When you get insurance for your car, you don't pay extra to invest money with your car insurance. When you get insurance for your house, you pay for the homeowner's insurance. You don't put in extra to invest. When you get life insurance, it's all different. And they want you to invest. They want you to invest money, and they want to make it complicated. And there's all these what ifs and caveats, and there's these projections about how much money you're going to make. And I can do more of these. If you guys really like today's segment, let me know, Phil at polarisfinancialplanning.com. And I can do more different types of products and break them down. I've done this in the past. I can update those and refresh it. But the one I wanted to specifically talk about today is a thing called return of premium term. First time I ran into this, probably 20 plus years ago, 25 years ago, someone brought this up as a way for those people that are concerned about the cost of life insurance, that if you get this product, and I'm going to differentiate products between advice and product. So whenever I say product, you should assume that's a negative thing from my perspective. But the nice thing in their sales pitch for this product, return of premium term, all the money that you pay, all the bills and all of the payments that you send, all the money that you send them, after 20 years, you get it all back. 100% of the money, you get it back. And you might think, wow, that sounds like a pretty good deal, Phil. I mean, normal term insurance I pay every year, like you pay for your car insurance. If you don't have a car accident, they keep your insurance premium. The next year you pay for your car insurance again. Term life insurance is the same thing. You pay for the year. If you don't have a qualifying event, usually something like death, you don't get any money and your money's gone. Well, you're not investing. You're paying to cover for a contingency. So if something horrible happens, your death, again, your spouse and children would get a lump sum of money so that they can continue on in a reasonable manner, a way they can pay the bills and pay for college without you being around. That's, in my mind, the purpose of term insurance. But the salesperson will tell you, if you get return of premium term, you pay a little bit more, but after 20 years, you get 100% of all of your money back. So let's take a look at how this might work. I'm just making up these numbers for a mathematical illustration. I have not looked at an actual return of premium term policy in many years, but I just want to walk you through it. So you're in your 20s and the salesperson says, hey, you're young. You can get $1 million of insurance for $200 a year. Hey, not so bad. A very low payment, $20 a year, fixed for the next 20 years. And if anything happens along the way, your family gets $1 million. Not a bad idea. The odds of you dying are low, which is why the premium is so low. And the negative side effect of your death is pretty big on the family. So this is a good time for insurance. When insurance costs very little and the result is very big if it's triggered. So that's what you want to do. So it's $200 a year. You could pay that $200 a year for the next 20 years fixed. And voila, you're still alive after 20 years. And the $200 that you spent per year is gone. That's how it works. That's how it works with your car insurance and your home insurance. We've already covered that. But return of premium term comes along and it says, okay, instead of paying us $200 a year, you pay us $700 a year. Yes, I know it's bigger, but after 20 years, what we're going to do is turn around and the $14,000 that you've paid us over the last 20 years, if you're still alive, and the probability is that you are, you will have paid $14,000 in insurance premiums, and we will write you a check and hand you back $14,000. If something happens to you, your family gets $1 million. If nothing happens to you, you get all of your money back, $14,000. Now, on the surface, that sounds pretty nice. You get $1 million if you die. Your family gets $1 million if you die. And if you are lucky enough, as expected, as you hope for, you've lived 20 years or longer, you get your $14,000 back. Every penny you've paid to them, they just hand it back to you. And you might think, wow, that sounds absolutely fantastic. But the question I have for you, is it really fantastic? So let me break it down for you how it works. They take $200 that they would have collected from you for the regular term policy, and they set that into part of the company that pays for the term insurance. The additional $500 that you're paying, $200 versus $700, $500 difference, they invest that $500. And then next year they invest another $500. And then next year another $500. If I assume, let's see here, got a little spreadsheet here that I made. If they make 6% per year on that money, which right now is relatively easy to do from a long-term perspective, not necessarily in any given year, but if they invest it half in the stock market and half in bonds, they can easily make 6% going forward. They're taking on some risk, that is true, but there's a possibility they're going to make a lot more than that. But if they make only 6, after 20 years, that $500, $500, $500, $500, and then compounded will be worth $19,500. And they give you $14,000 back. So not only did they get the $200, which they would have been happy with for just a basic term policy, but now after 20 years, they've made $5,500 more than they are obligated to pay back to you. That's pretty cool. Well, you could have gotten the term for $200, taken the extra $500 and invested it and got the $19,500 for yourself. But instead, you only get $14,000 back and they make $5,500. That's at 6% return. Now, let's say because you are in your 20s or early 30s and you do this and you think, well, you know what? I'm going to just invest it in the stock market and use some index funds like Phil talks about. I'm going to ignore it, maybe with once a year rebalancing. I'm going to change the decimal place thing here. If I can. No, I can't. It's not going to let me. All right. So if you had done that, the $500 every year, making 10%, theoretically, there's no guarantee in this, but over 20-year time periods, the odds that you're going to make plus or minus 10% are pretty high. You can go check Wikipedia S&P 500, where they have the results for all of the years. And then at the bottom, they have, actually all the way through it, they have a column that says, what's the rolling 10-year average performance? And you can see how reasonable the 10-year performance is most of the time. Sometimes it gets crazy big, and sometimes it's not so big. But you get the idea. But if you make 10%, that $500 a year turns into $31,500. If they were to invest it in the stock market and take that full risk, they make $31,000. And then at the end of 20 years, they give you $14,000 back. And you might think, well, that's okay. They're taking the risk and I get $14,000 back. Now, the other things that are not disclosed, or at least not mentioned during the sales pitch, but they'll be disclosed in the 30-page document that you sign. If at any point in time you stop this policy, how much do you get back? It may not say. Well, it'll say, but it won't be something that the salesperson tells you. It might be that they give you all the money that you've paid in so far back, but I bet there's not. I bet it's not going to work that way. There's a possibility that they'll say, well, you didn't make the 20 years, so you don't get the money back, but that's okay. You had $1 million of insurance, so you're good. And they just pocket 100% of the extra premium that you paid. There's probably something where it says for the first 5 or 10 years, you would get nothing back. And then there's some prorated amount that you get back. Don't worry. They're going to make sure that they're covered, and they're going to make sure that they make money on the money that you gave them to invest and profit from the growth, and you just get the money back. That's pretty cool from their perspective. If at any point in time during the 20 years you die, they're likely going to pay out the $1 million as expected and pocket all of the extra money. So you do this for 19 years with 10% growth of an extra $500. That's $28,000 and some change. Sure, they pay out the $1 million, but then they pocket the entire $28,000. Well, you're not going to care because you're dead, but there's another $28,000 that your family or your estate or your kids could have had if you just had invested the money and ignored it. I'm not even talking about doing anything fancy. This is not a get-rich-quick scheme. And this is just putting it in a total stock market index fund and making 10% per year, which you may or may not make. But for illustration purposes, you would have the $1 million of insurance just for $200 a year. And then you could have an extra $28,000 that your kids get. If you're okay with just throwing away $28,000, send me an email and I'll give you an address and you can just mail me a check for $28,000. We'll be okay. Maybe I could do that. I don't know. It's probably not legal. I'd probably have to register as an insurance company. Maybe I could convince someone to give me $1 million and I'll hold it and then 20 years later give you $1 million back. What do you think? How does that sound? That doesn't sound good, but somehow when it gets wrapped up with life insurance, I don't know, does it play on emotions? Is that what makes it work? Is that why it wouldn't work with a car? You say your car insurance for the next 6 months is $500, but if you pay $1,200, we'll give you your money back. What? I don't think anyone would think that's a good idea, but with life insurance, it's different. Well, the math isn't different. So hopefully that helps. Return of premium term life insurance is probably not for you. They're going to take the extra that you're putting in as an annual fee. They're going to invest it and make more money on it. And then they're going to pay you back part of it at some point in the future if you qualify terms and conditions may apply, and things may happen that you get none or only part of it back. So just keep that in mind, and hopefully that helped you understand this creative term policy, return of premium term.
Those worlds in space are as countless as all the grains of sand on all the beaches of the earth. Each of those worlds is as real as ours. In every one of them, there's a succession of incidents, events, occurrences, which influence its future. Countless worlds, numberless moments, an immensity of space and time. And our small planet, at this moment, here we face a critical branch point in history. What we do with our world right now will propagate down through the centuries and powerfully affect the destiny of our descendants. It is well within our power to destroy our civilization and perhaps our species as well. If we capitulate to superstition or greed or stupidity, we can plunge our world into a darkness deeper than the time between the collapse of classical civilization and the Italian Renaissance. But we are also capable of using our compassion and our intelligence, our technology and our wealth to make an abundant and meaningful life for every inhabitant of this planet, to enhance enormously our understanding of the universe and to carry us to the stars.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. I recently had a very wonderful discussion with a prospective client, someone that emailed me back and forth, and they were kind enough to send me some statements. And this is not to pick on them. They might listen. I think they're going to listen. It is a very normal thing to have happen where they have an advisor that put them in a bunch of funds, and that advisor's job is to talk to you, to kind of be a salesperson, to make you happy. And the funds that they've chosen aren't even horrible. Not at all. I've seen far, far worse. So I thought when I was looking up these funds that since I'm going through the effort and trouble of looking these up, I might do a couple of these funds as a walkthrough for the listeners of the show. So if you have your statement from 12/31 or from the end of February, or if you hear this after March of 23, maybe your March 31st statement, you can look at the funds that are listed. Almost always they're going to list them. And if they're not listing them, I would worry about what kind of investment you have, because you may not have investments. You may have a product. That's the buzzword, that something that's more complicated. And if you don't understand what you have, give me a call. Well, send me an email, phil@polarisfinancialplanning.com. Include your phone number. Maybe we can schedule a time to talk, and maybe I can help you out. And maybe that's all you need. It's just a little more information. Fine. No big deal. You don't owe me anything. We can just talk. But I have this statement here. So again, this is not to pick on the people. I'm not going to tell you who they are, where they are, how much they have or anything, but I'm going to look at a couple of the funds that they were using that their advisor recommended for them. Probably reasonable to expect that the advisor was getting paid out of these funds. I don't know how much, and the person that sent me the statement doesn't know how much. And quite honestly, when they asked the advisor/salesperson, they were not able to give a clear answer. Now, that leads me to one of two things. One, they don't know how they're getting paid, or two, they don't want to tell you how they're getting paid. I'm not sure which is worse. Actually, I'm thinking If they don't know how they're getting paid, that's probably worse. Them not wanting to tell you makes sense to me. If they can't figure out, if they genuinely don't know how to calculate how much they're getting paid, well, why are you having them work with your money? I'm just saying. So they're either incompetent and can't calculate their own payroll, or they're being coy, misleading, deceptive. Well, how hard is it? They know what they're getting paid. Just tell you. I think most people are pretty reasonable, and they don't expect anyone to work for free. I sure as fuck don't. Well, I mean, actually, kind of the show is for free, but I do get clients occasionally from it, and that's how I've always made money, is I just give everything for free, and then some people hire me. I'm doing okay, so don't worry about me, but I do expect people that do work to get paid for it, because I'm sure you expect it. Anyway, so I'm going to go on. So the website that I like to use, and I like to use this because you can use it. It's not a paid subscription or a magical service that I'm getting that you don't have access to. It's available to everybody. Morningstar.com. For a small fee, you can pay and get extra perks. No, I don't get a commission or referral fee. I don't even pay for the extra stuff because I think the free stuff provides enough information for everybody. Really, honestly, everybody to look. The extra stuff might be fun to have, but what are you going to do with that information? Maybe there's some value to it that I don't understand, but I don't need it. I don't think you need it. But anyway, Morningstar.com. So one of the funds is American Funds Bond Fund of America, because that's not redundant at all, F2. So F2, whenever you see the name of a mutual fund, this is general stuff. So we're just going to do some general discussion stuff today. When you see letters at the end, A, B, Z, L, I, F, F1, F2, whatever, that means that is a load fund. Somehow the advisor is getting paid by that fund to recommend that fund. Not necessarily bad, but an inherent potential for a conflict of interest. So when I recommend Vanguard index funds, I can clearly tell you how much Vanguard is paying me. Not a fucking dime, not even a penny, not even a fraction of a penny. I get nothing from Vanguard. But this fund, American Funds, their Bond Fund of America, F2, is paying the advisor something. I don't know what that amount is. So just be clear, it could be 0.25%. It's probably more like 0.5 or 0.7, probably not 1 full percent, but I don't know. It could be even more than 1%. I don't have that information, so I'm going to skip on forward. So this fund is a bond fund, right? It's in the name. First caveat, the names of bond funds are marketing tools. You can have a growth fund and a value fund, or an income and growth fund, or a dividend stock fund. And the names can be very different, but those funds could all own the same shit. So this is nice because it says it's a bond fund, and it is. But you can have a stock fund that has half the money in bonds. You can have a bond fund that have half the money in stocks. They don't have to follow the words that they use in the title. So don't be swayed by that. Go to Morningstar.com and look up your fund. And you don't have to look up every single fund, but pick a few. Educate yourself on where your money is. I mean, if you have hundreds of thousands of dollars, or if you're fortunate enough, millions upon millions of dollars invested, what is it invested in? Do you know? Do you want to know? Do you want to know, but you don't want to look this up and you want Phil to look it up? Cool. Send me an email, phil@polarisfinancialplanning.com. So here's this example. Fixed income, 95% of the money in this fund is in bonds. Kudos, 95% of the money is in bonds. But strangely, at least at the time this data was collected by Morningstar, 5% of that money is in cash. Huh, that's awkward. It's a bond fund. It's supposed to be buying bonds. Why is it sitting 5% in cash? That will create a very small, but a drag on your portfolio going forward over time if they are consistently holding cash and the cash is making nothing. Why are they doing that? I would expect that they're going to tell you something like, we're waiting for a good opportunity to buy some new bonds. What kind of opportunity? I don't know. Just buy the bonds. It's a bond fund. Take my money, invest it in bonds. That's in the title of the fund. And that's what I expect you to do. Buy some freaking bonds. And you can see all of this again at Morningstar.com under the portfolio tab under the name of the fund. There's a bunch of different words: quote, chart, fund analysis, performance, portfolio, etc. Portfolio is really cool because you'll see this. You'll see how much is in U.S. equity, U.S. stocks, non-U.S. stocks, fixed income or bonds, other, which always concerns me, cash, and then not classified, as if other is not weird enough, not classified. Thankfully, not classified for this fund is 0.04%. So Morningstar didn't know how to classify a couple things. No big deal. But 5% in cash. Now, on top of the 5% in cash, that cash is comprised of 10% short cash and 15% long cash. I'm not going to go through all of what that means, but it means they're doing something really creative and they're making a game out of it, probably to make money for themselves. And so they're making money off the money that's sitting in your fund as cash, allegedly. I honestly don't know because I don't have all the details, but that's something that's weird for me. Another thing that you can see here is for this investment, the duration. We've talked about duration. Long bonds are inherently more risky. Well, yeah, more volatile, but that's the definition of risk. And so the price of the portfolio is more likely to go up and down with changes in market conditions, most notably risk, quality of bonds, and or changes in interest rates. So if interest rates go up, the bond will go down. In the past few years, I've been trying to keep duration or term, or the length of the bonds, under 5. This one's 6.23. Not too bad. There's also a cute little box, little grid here that Morningstar is famous for. It's not long-term bonds. It's not short-term bonds. It's medium-length bonds. It's not limited risk or extreme risk. It's moderate risk. So moderate term, moderate risk. The portfolio is AA minus. So on the whole, pretty good quality. So now let's move over to the performance tab. And I'm going to point out that for calendar year 22, this fund lost 12.5%. 12.5% loss in bonds. Ironically, that's not even horrible because the index, the total bond market index, is down 13, which is shown to you easily. You can see it here on this page at Morningstar. And the fund managers and your advisor and everybody could say, hey, we beat the index. They did. It's always very, very important that you understand what index are they comparing this to. And if they are comparing this to, as I think this is the case, the total bond market index minus 13%, they lost 12.5%. They outperformed that index by 0.5%. However, they have a little bit higher quality bonds and they have shorter duration bonds. So they were taking less risk, which worked out really well in this case because they beat the index. Not necessarily a fair comparison. But the funny thing is they did lose 12.5% in this bond portfolio because they had short-term, intermediate term, and long-term, a great big mix of all bonds available. Thankfully for myself and for virtually all of my clients, for years, maybe too early in the process, but for years, I have been avoiding intermediate and long-term bonds completely. Anyone who's listened to the show for years knows that I've been doing that. It would result in some awkward phone calls sometimes when clients would call and go, hey, my bond portfolio is only making 1.5. I could make 2 if I bought some long-term bonds. And my decision, my instructions, my directions, tough. I don't want to take the risk that's involved in long-term bonds to make a teeny-weeny little bit more. And we've talked about on the show, Vanguard's long-term U.S. Treasury bond fund last year lost something like 35%. Well, this fund has some of those kinds of bonds, which is why it's down 12.5%. versus the 6 to 7 to 8% maybe, depending on the exact mix for most of my clients would have made. So you're down 4 to 6% more than a more conservative bond portfolio. So in and of itself, it's not bad, but how did your advisor not know that this had long-term bonds? And why did they not avoid the long-term bonds? Maybe they just don't know how that stuff works. Okay, fine, whatever. We're just going to move on. I'm going to look at another one now. This is Fidelity Advisor Growth Ops. I think that's for opportunities. I haven't looked at the full name. Yes, opportunities. And again, growth opportunities. What does that mean? It doesn't mean anything, honestly. Another tab we have, actually under the portfolio tab, we can look and see what they own. Let's take a look. They own Microsoft, Alphabet, Amazon, NVIDIA, T-Mobile, Apple, Uber, AMD, Advanced Micro Devices, United Health Group. Let's see. Let's take a look at the next set of Tesla, Alphabet again, Visa, Humana, Exxon, Meta, Facebook. So they own all the names that are the names. It's kind of like a large cap growth fund. Matter of fact, it's very similar to the large cap growth fund index fund that I might use at Vanguard. And let's see how this did over the last calendar year of 2022. It was down 38.25%. Wow. And this is the kind of fund that people have called me recently. And they're like, Phil, you're talking about being down 13, 15, 18, and the market as a whole is down 19, but I'm down 30, 40% because you have things like this. Now, to be fair, I have things like this. I have the Vanguard Large Cap Growth Index Fund, which contains almost all of these same stocks, but it's a small part of the portfolio. And one of the things that I particularly like about what I do, which I think is wickedly valuable, is the granularity and clarity that I call it. And so for the U.S. stock market, I'll have large cap value and growth, mid cap value and growth, small cap value and growth. And for most of 2022, I only had half of the money in large cap and only 40%, therefore 20% of your portfolio was in large cap growth. For a lot of people, because of a lot of advisors and a lot of mutual fund managers, they did not want to miss out on the annual gravy train that was being provided by the large cap growth stocks. Apple, Tesla, Facebook, everybody wanted those. And God forbid if you managed your fund and you underperformed the S&P 500 or you underperformed the large cap growth, how do you explain that to your bosses and to your investors that you missed out? And so everybody piles on. And there's a term for this in investing world called momentum investing. And the idea of momentum investing is whatever did the best last week, last month, last year is what you want to invest in because it's likely to do the best next. Well, sometimes that's true. And then sometimes it's not. In 2022, we have a year of not the best. So if you have half a dozen different managed stock mutual funds, go take a look at what is inside, and you can do that for free at Morningstar.com. I should get paid by them. They should be a sponsor, although I don't take ads anymore. So, but you'll go find that they have all the same stuff. And when that part of the market turns against you, if you have all of your stuff there, you get a year like this. Now, the thing that's really interesting, calendar year 21, the market was up 28%. This fund only made 11. So sometimes it does better than the market. I'm looking back over time, and sometimes it does worse. And you have to be really careful because often advisors will recommend funds that have a good 3 or 5 or 10-year track record because they can show you the data. And so you get all these great funds that are beating the market, that are beating the indexes based on historical data. But then going forward, they don't beat the market because of statistical probabilities. It's just not going to happen. That's not how it works. But that's another bias that without knowing it, the advisor's recommending funds that are fantastic. But how are they going to do going forward? Well, this one lost 38. To be fair, large cap growth index fund, this is almost very, very similar to, I'll say, that was down 33, but this one's down 38. And again, it was way too much of their portfolio. Other fascinating things about this fund, again, this is Fidelity Advisor Growth Ops I think that's an I. The symbol is FAGCX in case you want to look it up. I go to the quote tab here on Morningstar.com, and I want to look for something called turnover. And there it is. Turnover, 75%. Now, you may not know what turnover is, so I'm going to explain it. A turnover of 100% would signify that the fund, if it had 100 stocks, would have sold 100 stocks and bought 100 new stocks. Now, it could have sold 50 stocks twice and replaced them twice, or it could have sold everything once and replaced it once. I don't have that detail. But I do know that they're selling the vast majority of everything they have and replacing it within a calendar year. That's why turnover is 75%. You can find, by the way, a lot of funds where the turnover is over 100, 150, 200%, which means they've traded everything twice. So I have to ask myself, if they have some kind of criteria or objective or agenda or goal or requirements or guidelines, whatever's in the prospectus of what they're supposed to do, what happened to cause them to change 75% of what they thought were good investments a year ago and sell them and then buy something else? If 75% of what they bought within the last 12 months turned out to be a bad idea, sufficiently bad enough that they sold it to buy something new, what makes you think that this new round of buying is not going to result in the same failure rate? Because if they thought those were good investments a year ago, did they not look past 12 months? Did something materially change? Is it 75% every year? Why are they jumping in and out of stocks? The other funny thing is that the expense ratio for this fund, by the way, is 0.64%, so less than 1%, which is nice, below the average. But keep in mind, this is a very nuanced point, so forgive me. The expense ratio shows you the percentage of expenses as compared to the overall value of the fund. The expense ratio only includes the expense items that are required by law to be included in the expense ratio calculation. It may sound redundant or totalic or whatever. It only includes what it includes. Every mutual fund includes everything they are required to include, but they do not include things they are not required to include in the expense ratio. And one of those categories, which can be a big category, is transactional costs, trading costs. It costs them money to buy and sell stocks. I'm not going to go over all the reasons and whys of that. We've done that in other segments, and I can do it again. But they're paying all of that stuff. That can be a lot, especially if they turn over 75% of the portfolio. That doesn't show up as part of the expense ratio, but it shows up as part of the underperformance, which is maybe part of the reason why this fund lost 38% in being in the large cap growth of the U.S. stock market, while the index fund only lost 33%. So you're down 5%. And because they're thrashing around, you lost more money. You made less, but you lost more. The other thing that's really fascinating with turnover, if this is in a taxable account, there is some small effect in a non-taxable or IRA or Roth account, but the big effect here is for a taxable account. If you buy and hold, if you're in an index fund, and I happen to look up VIGAX, the Vanguard Large Cap Growth Index Fund, its turnover for last year is 5%. So 95% of what they had at the beginning of the year, they had at the end of the year. That's buy and hold. We all know this phrase, buy and hold, buy and hold, buy and hold. Why change 75%? If you buy and hold 5% that turns over, that 5% that turns over may subject you to short-term tax rates. Now, odds are, because the turnover is 5%, that the vast majority of whatever they sold last year, they probably owned it more than a year anyway. 2, 3, 10, 20 years, whatever. So the vast majority of that in a taxable account is going to hit against long-term capital gains tax rates. If your income is low enough, that tax rate is 0. For most people with reasonable incomes up to what many would consider above reasonable incomes, the tax tier for that is 15%. Over $600,000 or $700,000 a year for a couple, it might go to 20. If you sell a lot of things, have a lot of capital gains, have a really great income, it might even be 20 plus another 3.8, 23.8. But for most people, it's going to be either 0 if your income is under like 70,000 for the year, which is a lot of people, or 15%. But it's only on the realized gains. It's only on the things that are sold. If you have a fund that has a turnover of 75%, the vast majority of what they're selling, they could not have, just mathematically, they could not have owned it for a year. So in that case, depending on your income, instead of paying 0 or 15 or 20, you're going to probably pay, you could pay 12 instead of 0, but you could pay 22 or 24 or 28 or 32 instead of 15, or you could pay 32, 35, 37 instead of the 20, and maybe even additional tax for your state, depending on your state income tax rates. Your situation may be different. Variances may apply. Check with your tax professional. But in general, you're going to pay a lot higher tax rate. And the really important thing, I need to stress this, not only are you going to pay a higher rate, you're going to pay that tax this year. You're going to pay it in the year that these gains are realized. In the fund that has virtually no turnover, the 5% turnover, that means 95% of what they had, they still have. It doesn't matter how much it goes up. You owe, at least in that calendar year, no taxes because there was no gains realized. They're only realized when you sell it. So a fund with a very low turnover, a very low expense ratio, the expense ratio keeps more money in your pocket, and the low turnover keeps a lot more money in your pocket because that 0 or 15 or 20%, you're paying only on the things that's sold. Everything that you keep, no taxes are due in that year. And you get the ability to compound the returns year after year after year on the things you're not paying taxes on. In a way, index funds can be really close to the value of having money in an IRA for a very long period of time. It's absolutely amazing. If you can pay lower taxes and avoid most of them for years to come, that's pretty freaking cool, and that's very valuable. That's a very important reasons to have index funds. It's not just that you perform better, but you keep more of it, and you keep more of it every year. And the really amazing thing is if you have index funds in a taxable account and your beneficiaries are your descendants, when you die and you give it to them up to certain limits, which are something like 10 or 12 or $14 million, they get all of that money and they get to enjoy a thing called a step-up basis, and they get the new higher values and they pay no tax until it grows further. But if you invest $500,000 over 20 years and it becomes worth $1 million, and then you die and you give $1 million to your kid gets $1 million fucking dollars. No tax. No tax. It's called the step-up basis. Go look it up. A lot of people are like, you can't be serious. And this is one of the many bazillion rules that get added over time by wealthy people so that they can get even more advantage. I know. I beat this drum before. But so there's that. Let's see. Is this the other one I wanted to look at? There was another one. I don't know which one it was, so I'm just going to tell you about it. It had more than, here's one, 6% of them. Oh, I did want to talk about this one. This is American Fund's New Perspective. New Perspective. What's wrong with the old perspective? What is a new perspective? By the way, it's New Perspective F2. The symbol is ANWFX. You can go look it up. It's another large cap growth fund. And so here is a portfolio of multiple managed mutual funds, but yet almost all of them that are based on U.S. stock are large cap growth. Where's the large cap value? Where's mid cap? Where's small cap? Also, they had a very small portion in international, But the funny thing is, look at this fund. You're going to love this. Again, Morningstar.com. The U.S. equity is 48%. The non-U.S. equity is 46%. Did you know that? Did you know that when you bought that? You didn't. You didn't even know that you could look this thing up. Did your advisor know that? Did the advisor know that this is almost 50-50 U.S. versus international? And of course, because you don't have the clarity and you don't have the granularity, if you want to have more international and less domestic or vice versa, how do you change that? You go buy an international fund, but did you know that half the money in this fund is already in international? How do you know that? You go look it up at Morningstar.com. But you don't have that easy clarity where you can change things and change the percentages. Or if you want to add new money and not sell something, you can add new money just to the international index fund that you have, because you don't have this fund. You have domestic index funds and you have international index funds. So you can control precisely. But this one has 6% cash. So that 6% is sitting there forever. Well, I don't know about that. Sorry, I overstepped. At the time this data was collected at 6%. That 6% is not working for you. Is it always like that? I don't know. Turnover of this fund is 21%, so way better than 75%. The expense ratio is 0.52. Let's look at performance. I don't remember how this one did last year. Minus 25. And so international actually did a little bit better in 22 than domestic large cap growth. So minus 25 is reasonable. The previous year it was 18%. So, not bad performance, but will it be that way next year? I don't know. The expenses could eat into that. The cash on hand could eat into that. And like I said, you don't have any way to see what the advisor is making. You don't have any way to control or move things around. Anyway, I think you got the idea. These are things that you can look at. And I gave you a lot of the rationale for why you want to have index funds, the lower costs, the lower tax consequences. And it's not just lower expense ratio. It's the lower cost, the trading costs and other costs, because the whole point, particularly at Vanguard, is to keep all the costs low, even the costs that aren't reflected in the expense ratio. So you end up with more money. We can get down to the point, like sometimes people will say, Phil, that mutual fund has an expense ratio of 0.05% at Vanguard, but I can get it at Fidelity for 0.00, free, expense ratio of 0. Well, okay. Do you think they're doing that work for free? You know they're not. There's other things that they do to make money with the investments that may show up as other expenses or reduce your total return. So look, I'll have to do this, another segment. I'll look up, I've done this in the past, but Fidelity's total stock market index fund versus Vanguard's total stock market index fund. They're probably pretty close, but I'm willing to bet that the difference is bigger than the 0.05% that you think you're saving. So you're going to end up net at a loss. Vanguard is just, right now, they're the shit. So sorry, that's that. All right. Longer than I wanted, just some sample things that you can look at, how to look at them, how to look them up on Morningstar, what the information means, and ways you can tweak and make more and more money every year. You can keep more money. You can pay less taxes. That shit adds up. So hopefully that helps in some small way to help you review your own portfolio. If you want a little extra guidance on that, again, send me an email, phil@polarisfinancialplanning.com. And now we're going to go do something else.
You're listening to The Bill Ferguson Show.
Hey, poor! You don't have to be poor anymore! Jesus is here!
Thank you so much for listening. I really do appreciate you being here. And as I said almost an hour ago, if you like the show, leave a 5-star review, tell a friend, go donate to some other podcast and tell them the Phil Ferguson Show sent you. Just as a quick reminder, it can take me anywhere from 2 to 5 hours to make one of these shows, between emailing guests, interviewing guests, recording segments, mixing it, publishing it, all that stuff. I enjoy doing it, but it is work. So take your appreciation and give money to somebody else. I really do mean that. I'm going to wrap up because I've spent a lot of time on this already, and I'm going to mix this together. And you'll hear the end result. And then I'm going to go climb in my pool, which today, and it's late March, is probably going to be 92 degrees or more, maybe getting too hot, but I'm going to go enjoy that this afternoon. And, I hope to see you somewhere soon. I will be at the American Atheist Convention in Phoenix for the Easter weekend, and I will have lots and lots of friends there. So please feel free to come up and say hello to me. I look forward to it. I do have a table there. It may be the lamest table you've ever seen because I'm going to be flying from Orlando to Phoenix, and I don't even have my tablecloth. So I'm just going to have an ugly naked table with some cards on it, which might be enough to be a conversation starter in and of itself. So please come by and see me off and on at my table. I'll try to listen to some speakers when I can. I'll see you in the hallways. I'll see you at dinner. Please feel free to say hello. And I do look forward to seeing you somewhere out there on the road. Until then, ciao.